Howdy, folks. Welcome to Liberty Call. Today is Wednesday, January 17th, 2024. Hope everybody's having a fantastical day out there in the interwebs. Just me here at the Camp Dolman. My wife is headed off on a business trip for the rest of the week. So it's just me and, well, my dog's upstairs staring out the window, waiting for her to come back. I tried to tell him it's going to be 2 days, but he doesn't seem to listen. So anyways, hope you're having a good day out there. It is finally above freezing here in Colorado. What is the temperature right now? It is a balmy 46 degrees outside. So you don't even have to wear a coat. I mean, it's like warm. Well, for us, I mean, if you're down in Texas where a lot of my friends and family are, they're bitching and moaning about the freezing cold. And oh my God, should we drain our pipes? And it's like, what? It was below zero here for like 2 days. I mean, come on. I didn't do anything. I mean, I got the little covers on the outside of the hose bibs, but that's all. Anyways, if it is your first time watching Liberty Call, again, I'm glad you're here. Thank you very much. If you could do me a favor, yes, you in the purple shirt, give me some thumbs up, a like, a share, a subscribe. Press that notification bell. And before I get started, it is my father's birthday, so I need to extend a happy birthday to my father, Raymond Dolman Jr., Butch. Let me see. I got a picture up here I could probably share. Let me put that on the screen. Oh, hang on. Where are we? There we are. There's the old man. He's 74 today. So this picture was about 15 years ago. So he's got a beard now, and well, so do I, obviously. So anyway, so happy birthday, Dad. Hope you're having fun and, well, like you said earlier, complaining about the cold. So, all right, well, let's go ahead and jump into the numbers for today and see how they did. It was another ugly day in the markets here domestically. The Dow Jones was down 0.25%, 94 points, closed at 37,266. S&P 500 was down 0.49%. Closed at 4739. NASDAQ down 0.59%, closed at 14,855. The VIX was up 6.43% today. It's up to 1473. So let me pause here, guys. When the VIX is under 20, that's your green light. That means things are okay. 20 to 30, that's your yellow light. It typically means proceed with caution. If the VIX gets up over 30, which it does when things get really volatile, that's your red light. I mean, you're welcome to keep going, but I'd look both ways before going through that traffic. So, all right, back to the numbers. Canada was down 1.21%, Brazil was down 0.53%, and Mexico was down 0.2%. In Europe, Germany was down 0.84%, the UK down 1.48%, France down 1.07%, Netherlands down 0.91%, Spain down 1.26%, Italy down 0.79%, Switzerland down 0.72%, and Portugal down 1.44%. Russian exchanges were split today. MOEX up 0.18%, the RTSI down 1.01%. And the overnight, the Nikkei in Japan was down 0.32%, Australia down 0.29%. New Zealand's market is open right now. It is up 0.06%. In China, the Shanghai was down 2.09%, the Shenzhen Component down 2.58%, China 50 down 2.34%, DJ Shanghai down 2.18%, Hang Seng down 3.71%, and the Taiwan weighted down 1.14%. So it looks like the Chinese markets were all down, 2-3%. The European markets anywhere from around 0.5% to 1.5%. And then here, everything was down under 1%. So, all right. Well, that is the global markets for the day. They were not in good moods. So let's go ahead and hop over to the market recap, see what it had to say. All right, U.S. stocks declined on Wednesday as rising Treasury yields and stronger than expected economic data diminished investor sentiment for a Federal Reserve rate cut in March. The 10-year Treasury note yield surpassed 4%, reaching its highest level this year, following a 0.6% increase in U.S. retail sales for December, surpassing the expected 0.4%. The robust consumer performance, a significant contributor to economic growth, suggested the U.S. economy's continued strength, reducing the likelihood of an early rate cut in March. I've been saying that, folks. I mean, unless the economy falls apart between now and March 30th, April 1st, when that meeting that everyone's, put the brakes on, back up. The March meeting is March 19th and 20th. So between now and then, so we got about 60 days. If the economy doesn't collapse between now and then, we don't have some black swan we aren't expecting. I mean, disease X is out there that everybody's talking about, is the new super cold that's going to kill everybody. Anyways, all right, let's get back into this. The probability of a March cut decreased from 61% to about 50%, according to investing.com's Fed rate monitor tool. Federal Reserve Governor Christopher Waller's comments on resilience of the U.S. economy, indicating potential rate cuts later in the year rather than in the near term, further influenced market sentiment. Yeah, but he's mad. They're selling off their stuff because they know that if the Fed, cuts rates or infuses cash into the economy, that makes the market go this way. Continuing to do what they're doing by squeezing, credit and lending, it's going to push the markets down. In the financial sector spotlight, Charles Schwab's stock declined 1% after reporting a 22% decrease in net profit for 2023 due to challenges posed by a tighter interest rate environment. On the positive side, Interactive Brokers rose 2% following fourth quarter revenue surpassing analyst estimates, despite earnings falling short due to decreased net interest income. The U.S. Court of Appeals for the Federal Circuit reinstated the ban on the sale of certain Apple Watch models with the blood oxygen feature following a patent dispute with medical device maker Masimo. Tesla faced a more than 2% decline after reducing the prices of its Model Y in Europe, raising concerns about potential margin pressures. Boeing stock increased by 1% after the Federal Aviation Administration completed preliminary investigations on 40 Boeing 737 MAX 9 airplanes, indicating progress towards potentially ungrounding the aircraft. Walt Disney experienced a 3% stock drop after rejecting activist investors' board nominees, asserting the company's current leadership has made substantial progress in its overhaul efforts. Energy stocks declined 1% as oil prices stumbled due to disappointing growth from China, the world's second largest crude consumer, sparking concerns about future demand. EOG Resources, Marathon Oil Corporation, and Valero Energy were among the companies affected, with a nearly 2% drop in their stock values. So, yeah, it's kind of the day in the markets. So let's go ahead and dive a little deeper into some retail sales. They had some good numbers. Strong U.S. retail sales underscore economy's momentum heading into 2024. All right, where is the start here? All right, here's my notes. All right, U.S. retail sales exceeded expectations in December, posting a 0.6% increase driven by higher motor vehicle and online purchases. This upbeat report from the Commerce Department led economists to revise their fourth quarter economic growth estimates. The strong retail sales data challenges market expectations of a Federal Reserve interest rate cut in March. The 10-year Treasury note yield surpassed 4%, hitting its highest level this year following the release of the retail sales report. This surge in yields raised doubts about an imminent rate cut, with the odds falling to about 50% from 61% a year earlier. Earlier in the year. Fed Reserve Governor Christopher Waller's recent comments, we talked about this in the previous article, on the U.S. economy's resilience also contributed to market sentiment, stating that the economy is, quote, doing well, and that's in quotes. The next article will argue against that. Various sectors contributed to the retail sales growth, with motor vehicles and online sales being significant drivers. Online sales increased by 1.5%, reflecting the continued trend away from traditional brick and mortar retailers. Motor vehicle and parts dealers saw a 1.1% acceleration in sales due to increased availability after strikes ended. Other sectors, including building materials, sporting goods, and clothing stores, also reported gains. Despite potential data distortions during the COVID-19 pandemic, the healthy pace of spending has been maintained, supported by a resilient labor market and retail discounts. The online shopping trend, accelerated by the pandemic, remained prominent. The unchanged reading in sales at food services and drinking places, a key indicator of household finances, followed a 1.7% surge in November, possibly influenced by a wet December affecting restaurant and bar traffic. Across the whole country, it rained everywhere. Okay. Financial markets adjusted their expectations of a Fed rate cut in March, with odds decreasing to around 53%. The dollar strengthened and U.S. Treasury prices declined. Economists anticipate the consumer spending will remain robust in 2024 until it isn't, provided the labor market does not significantly weaken. There's that caveat. Potential bipartisan deals in Congress to expand tax credits are seen as additional support for spending. Excluding specific categories, core retail sales rose 0.8%, aligning closely with the consumer spending component of GDP. The positive retail sales report led to upward revisions in economic growth estimates for the fourth quarter. So, the numbers right now, or at least the trailing numbers, look really good. So, like I've said, don't look at trailing numbers and say, hey, things are going to be fine out in the future. Sorry about that. So it's kind of like the employment numbers. Companies don't fire people until they really, really, really have to. So, we saw this with, all the layoffs after the whole COVID debacle 3.5 years ago, and, trying to get people back into the workforce because, hey, when the government's giving me free money, why do I want to work? But so right now, employers are, just holding on to their people as much as they can. So I just, we'll see the layoffs when the bottom line for a lot of these big businesses really start to feel the crunch. So, all right. One more article here comes from our friends over at the Mises Wire. It's titled, "The Government is Making the Economy Appear Better Than It Is." And this was written by Connor O'Keefe. So I didn't do a summary on this one. I'm going to read this one verbatim right off the screen. It's not very long, so we're going to blaze through this one real quick. All right. As of the 2024 general election gets closer, Democrats and pro-establishment pundits are growing frustrated with the American public for not feeling as good about the economy as so-called experts say they should. The elitism of this view aside, it's true that traditional economic indicators are pretty good, and that at the same time, people aren't feeling good about the economy. Yeah, it's kind of, it's just nothing bad has happened yet. People are just kind of waiting for a shoe to drop, I think is what it really is. Center-left economists have been locked in a debate over whether people are lying to pollsters about experiencing hardship in what is actually an excellent economy or are struggling due to mysterious non-economic factors. Well, let me break in here again. Where I can tell where people are feeling it the most, the grocery store. It's just the two of us here in this house. Our kids are married and have their own lives. So, but what used to be a $50 trip, once a week just to get the consumables, it's now $75, $80, over $100. And, I can absorb it, but, if you were living hand to mouth already, you're probably getting, rice and beans and, ramen, things like that. So it's not a mysterious factor. Others, like Paul Krugman, who's a certified idiot, have decided to blame Donald Trump and his supporters, framing the widespread economic pessimism as a MAGA ploy to win back the White House. Yeah, that's their thing. Okay. A theory Jonathan Newman showed is disproven by the very data Krugman cites. And there's a link here if you want to go and see that. So what's really going on? Daniel LaCale laid out the truth well in his recent appearance on Rothbard Radio. In short, the government is making the economy look a lot better than it is. Those who argue the economy is, and actually there's a link here to his appearance on that show if you want to listen to it. Those who argue the economy is doing great usually cite economic growth as measured by gross domestic product, or GDP, and various measures of the employment rate. And while on the surface it seems to make sense to use these indicators to get an idea of how the economy is faring overall, there's one big problem. None make any serious distinction between private economic activity and government spending. But there is a big difference between the two. Government, unlike any other entity in the economy, can simply take money and resources from others to spend on things and hire people. Whether or not spending brings people value is irrelevant. It's the private sector that's responsible for producing goods and services that actually meet people's needs and wants. So the private components of the economy have the most significant effects on people's economic well-being. And according to LaCale, the private sector of the economy is already experiencing a recession. However, the levels of government spending are artificially boosting the GDP above the technical recession threshold. Similarly, government hires have featured disproportionately in the recent seemingly positive jobs reports. That's why we're seeing divergence between the positive economic data in the headlines and the more negative sentiments of the American people. It's not a mystery. It's not the fake news or partisanship. It's the government. But don't expect any politicians, center-left economists, or pro-establishment pundits to admit it. all insist the government can boost economic growth and employment, especially during times of war. Yeah, because war spending is great, unless you're getting bombs dropped on you, like in Yemen or Gaza or wherever. Take, for instance, the myth that World War II brought an end to the Great Depression. That's a lie. What happened back then is similar to what we're dealing with now, albeit on a much larger scale. The government spent and hired enough not only to hide the destructiveness of the war, but also to make it appear like a good thing for the economy. That's the same trick at play today, because government printed trillions of dollars to hide the economic damage of the COVID lockdowns. A tremendous amount of malinvestment has locked in a major market correction. Now, as the economy begins to falter, the government is again spending and hiring on a massive scale to keep up the illusion of a strong economy. But most Americans can tell something's off, and they're right. So, I agree. I mean, things aren't wonderful. I mean, again, we don't have fighting in the streets or people killing each other for food or anything like that yet. Hopefully it doesn't get that bad. But the government's put us, they painted us into this corner, and we either have to wait it out and wait for the building to fall down around us, or we have to walk across the wet paint and get out of the building before it falls down. So, choose your battles. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.